Afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. The reason we do this is because we like to try to figure out what type of environment we are in, what kind of trading is prevailing, and try to match our trading strategies to that. If we're in a strong bull market, you typically want to take a lot of long trades. If you're in a choppy market, you typically want to take either less trades or quicker trades. And just generally speaking, you just want to make sure that you are matching your trading style to whatever the prevailing trading environment is. And so that what we try to do on these Wednesdays is try to identify what the market conditions are and how we should go ahead and approach them. If you like what you see here, you can always follow me on Twitter and the name Stock Darts. You can find these videos under the same name at YouTube, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, as well as just generally expanding on the information we cover during these Wednesday market reviews. You can also find the recordings of these Wednesday market reviews on there as well. So that's typically the best place to go ahead and try to follow me if you like what you see here and you want to see more about my trading style and how I go ahead and approach trading. If you ever have any questions regarding the content on here and you're not live, you can always message me on Twitter, and I'd be more than happy to help you out. Same thing if you have a chart request. If anyone in here has a chart request, feel free to type it into the chat, and we will definitely go ahead and take a look at it during today's stream. But if you're watching this as a recording, you can always just reach out to me on Twitter. I'd be more than happy to go ahead and try to give you your chart requests through that medium as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY, and as we can see, we are very near all-time highs. We are once again in a pretty strongly trending market. We have been in a series of stair steps since about March, or really since February, but generally speaking, the overall trajectory of the market has continued to just be going up. Especially if you look at the S&P 500, you're going to see a little bit of a different picture as we go through the four major market indices, each one of them giving us a little bit of a different twist on the overall flavor of the year. But generally speaking, most equities have gone up this year, and definitely as far as the major market indices are concerned, they've generally trended higher for the most part. However, we have done so, like I said, in sort of a very deliberate fashion, where we just kind of go up and then we chop around for a bit, then we go up and then we chop around for a bit and then we go up, and that has allowed it to extend the length of this rally a little bit longer than maybe if it would have just been a straight rally up, as there's been plenty of selling and plenty of shares exchanging hands in order to get new blood into the market without really having any kind of steep price correction. And so what you end up getting is something very similar to what we're seeing here. If you take a look, basically we'll backtrack a little bit to the end of last year, and you can see we had a rally that started back in November, and for the most part you can see these trend lines have contained the price action pretty clearly, showing that the market has been in a very steady trend. However, within that, you can see there have been pretty decent chunks of time where we trade sideways. You can see that we traded sideways. I don't have rectangles on all of them, but you can see we traded sideways here in December for a little bit of time, and then again in February and March, and then once again at the end of April, May, and even the beginning of June. And now we've begun kind of doing the same sort of thing. We've had our markup phase where we've kind of run up. We're still trying to figure out exactly where the ceiling is, but you can see we're already starting to kind of drift sideways and just retest these moving averages. And so far, every single time that we've come back and tested the 20 and the 50-day moving average, we have found enough buyers to be able to push the price action back up and to continue the rally. And until that changes, we have to assume that the prevailing market conditions are going to stay the same, and that we are going to have a market that can continue climbing upwards. And so what that means is that we continue to trade to the long side and just make sure that we don't get too caught up. One thing you'll notice, like I said, is you'll typically have a nice string of green candles and then we'll chop sideways, right? We had a nice string of green candles and then we started to chop sideways, and we're starting to maybe string along a few more. What you want to do is make sure you don't get caught up in chasing the price action, because very often what's happening is after we have the nice little string of green candles, we get a little bit of a shakeout, and a lot of the traders that try to chase it upwards are the ones that get punished. And so if you feel like you miss a move, then just wait for the next pullback, or wait for the next nice consolidation sideways, and go ahead and enter as long as you have a good risk-reward situation in order to make sure that you aren't punishing yourself by trying to buy at highs as stocks are trading up. Now, we have one major consideration during this week and the next week, and that is that we are in the middle of an earnings season, and a lot of names are reporting earnings. We are in the probably the busiest of the 2 weeks of the quarter as far as earnings are concerned. We've had a couple of the major FANG stocks report, and we have a couple others that are reporting today and tomorrow. And so we've reached the point now where we want to be careful that we aren't taking a trade on a stock that's about to report earnings, because anyone that's been trading for a while knows whenever you have a stock that reports earnings, no matter how good or strong the stock may be, it's going to have uncertainty and the possibility of extra volatility coming in, regardless of how strong the stock may look. And so what we want to do is make sure that we are keeping ourselves in a spot where we're not going to get punished. You know, the number one job of a trader is to manage risk. It's not actually to seek out profit. That can actually come secondly. If you manage your risk and you put yourself in a situation where you're constantly seeking more reward than you're risking, you're going to put yourself in a favorable situation where you're more likely than not going to be profitable. But if you're the kind of person that chases profits and kind of throws caution to the wind and ignores your risk, then more often than not, you're going to get punished and you're going to end up losing money. And so the first thing you want to do is make sure you have money to trade, which means you want to protect yourself. And I feel one of the easiest ways to protect yourself, if you are a short-term swing trader, is to make sure that you aren't trying to trade directionally during earnings. If you're a longer-term trader, someone that holds stocks for more than 3 months, then obviously you have to hold through earnings, as there's an earnings event every 3 months for every stock. But if you're someone that's just trying to trade a stock from day to day or from week to week, then you typically want to step aside and ignore earnings and just wait for the earnings report to finish, and then try to trade right after that. That's actually one of the trade ideas we had this Monday. Actually, both of the trade ideas we had was looking for stocks and waiting to see what happens during earnings, and then maybe go ahead and try to trade them after that. And I'll highlight that in a minute when we get to the tech stocks as to what we did this week. But what you want to do for the most part is make sure that you aren't putting yourself in a situation where you're going to get punished by a 10% move or 20% move on a stock that typically only moves 2 or 3%. And you might have your stop at maybe 3 or 4% of what the stock moves, and then it gaps down 10%, and you put yourself in a situation where you have to try to figure out how you want to exit that trade, but you get punished and take maybe double or triple the loss of a normal trade because you weren't ready for the kind of move that can happen during earnings. Now, of course, it can always go in your favor, but that's not the idea here. It's you don't want to just kind of hope that things get lucky for you. You want to make sure that you reduce exposure and control your risk, because that's really the number one job of a trader. So with that being out of the way, let's go ahead and really dig into the S&P 500 and see what we can expect. Now, like I said, we had a little bit of a shakeout. You see, we came back and we tested the 50-day moving average. Buyers immediately stepped in. This was a very interesting turn because it looked like the market was really kind of settling in for a longer consolidation or possibly even a break of this channel. And instead, buyers immediately swooped in and bought it and pushed it not only to new highs, or well, not only to the previous highs, but up to new highs. And as you can see, I'm going to draw a little tiny trend line here. We'll zoom in. And you can see not only did we actually break to new highs, we're actually consolidating above the previous highs, which again is a pretty bullish sign. And it shows that for the moment, buyers are considering what used to be resistance and support. Now, this could hold, this could not hold. You can see at the moment the two candles that we have over the last 2 days are not really inspiring the most confidence in the world, but they are, generally speaking, trying to hold up. And so, like I said, it looks like we are still in a pretty bullish market, and the only thing we really need to worry about right now, like I said, is making sure we're not chasing price action and making sure we're not getting caught up in a stock that's about to trade earnings. And other than that, things are looking pretty good. Now, what is potential resistance? Well, we're at all-time highs, so the only resistance we could really come up with is theoretical, and it's probably the top of this channel, which means we have room to run up even higher. Now, as far as support is concerned, we do have, obviously, this very short-term level of support around 437, which we are currently dealing with. Just below that we have the 20-day moving average, and more importantly I think is the 50-day moving average. As a trend matures, this is kind of a mature trend that we are seeing right now, the 50-day becomes more important than the 20. As you know, it's a function of math. Eventually price action will break through the moving averages, and as you can see we've been violating the 20 a lot more often. However, the 50 so far has held as pretty good support each time, and so that's going to be the more critical area. Now, just below the 50-day moving average, we have this 422 area, which is the ceiling of the last real consolidation range we had, and I consider this to be the major support zone that we need to concern ourselves with in the short term. For now, this is the level that we would really want to make sure doesn't get breached. I think the longer this goes on, the more likely that we lose this trend line and we lose the 50. And if we do, this is the trend line that's going to be important, or this price level. However, for now, from here to next Wednesday, particularly now that we have a couple of the FANG stocks out of the way, unless we have really, really ugly earnings coming out in the next week from some of the bigger names, I don't expect us to come down and test this 422 from here to next Wednesday. I think more likely than not what we're going to do is either settle in around this 437 area or possibly dip down somewhere into the low 430s and try to find support there. And more likely than not, we don't breach the 50s. So I think overall, we can look at this week, the rest of this week and the beginning of next week as more of a status quo type of thing, where we should expect price action to remain similar to what we've seen recently. And if that's the case, then probably what we're going to see is another attempt at new highs, and whether or not that succeeds or not will determine whether we come back and test the 50 or not. Like I said, you can see yesterday we tried to break down and failed. Today we're still sort of finding selling pressure, but we're not really dropping. And so the next step is probably for the bulls to try to push the envelope and push the new highs. And I think if that fails, that's when we really will see whether we kind of fall back a little bit more. And so those are the key levels. Like I said, I think we're in a pretty decent bull market. My focus, as it has been for quite a while now, is just buying dips and making sure that I'm buying stocks that have good risk reward rather than chasing the price action. I feel that the longer this goes on, the more likely that we will eventually get a bigger drop that's going to catch people off guard. But until that happens, you don't want to sit on the sidelines while we have this kind of a rally going just because you get nervous because the rally's gone on for so long. You still want to participate and you still want to take advantage of the upwards price action. You just want to make sure you control your risk, and I think that's really the key. Now, if we take a look at the NASDAQ, we're going to see a little bit of a different picture. You can see more selling pressure coming in, particularly yesterday. Now, again, that's going to be due to the fact that FANG stocks are reporting this week. I believe it was Apple. We'll go into them in a second. I believe it was Apple that had a little bit of a drop. Tesla had a bit of a drop on Monday, or actually no, on yesterday. And so this was part of what happened with the NASDAQ. However, you can see still we're pretty much at all-time highs. Really just, what are we at here? 365, and all-time highs are about 368, so 3 points off of all-time highs. Found support at the 20, came nowhere near the 50, so this is still a pretty bullish chart. The only real negative is that we had a bigger red candle yesterday than we did on the S&P 500. Now, the big difference between this and the S&P 500, of course, is that we don't have that same steady channel that we had on the S&P 500 since November of last year. You can see we had a nice channel. We broke down, consolidated sideways, held up, and then bounced up, had another consolidation, and then broke out. And now you can see we're beginning to start to shift neutral again. We broke this little skinny channel and we tested the 20 and are right back to testing highs. So generally speaking, it's doing the same thing as the SPY. It's just doing it with a slightly different configuration. But really we're still doing the same thing, which is probing towards new highs and trying to establish price action above the previous zone, which I think the major zone was this area between about 325 and about 340 or so. And that was the second step of the consolidation that we had. It was similar to the S&P 500. And like I said, we broke out, and we could be beginning to consolidate sideways again. But I think for now we could just look at this as one temporary pullback. And what we need to see is how we behave now as we test the 20 and whether we test the 50. Like I pointed out a couple of weeks ago, the configuration of the moving averages is telling us that this looks like a rally that is going to continue. And if that's the case, then we'll see the 20 hold as it has, and we'll see again a push to new highs. similar to what I thought might happen with the S&P 500. So that's what we're going to be watching for again, is to see what happens here and whether the NASDAQ can challenge these highs again and push towards new ones, or whether we fail here and have to come back and test the moving averages. Much like the S&P 500, I think that the 50-day is probably the more significant test that's coming. And just below that, around 342, this green trend line, which again coincides pretty much with what I just pointed out on the S&P 500, which is the same green line over here at 422. That's going to be relatively the same relative marker that we're seeing on the NASDAQ. And I would expect price action to hold above that unless we start to see some really drastic change in news. Whether it be because of the coronavirus, whether it be because of the Fed, or whether it be because of a really big downshift in earnings reports. If we don't see any of that, then I don't think that we come back and breach this level, and I think that we just kind of play between the two moving averages. So that's really what we're going to focus on for the temporary moment, is what happens here between the 20 and the 50-day, assuming we can't push to new highs. You take a look at, so we have, just to reiterate how important earnings season is right now and what we're in the middle of, you can see Facebook, they report earnings today after the market, right? We take a look at Amazon. Amazon reports tomorrow. Take a look at Apple. Apple reported on Monday, and you can see that was part of the reason the NASDAQ started to pull back. Netflix reported last week, and they pulled back on their earnings as well. However, they have provided us with a good long trade. So this was one of the trades that I focused on Monday in my Patreon site. Was a way to avoid earnings is to look for stocks that have already reported earnings and try to trade, because after, once they report earnings, obviously all the uncertainty's out of the way, all of the volatility's out of the way. And if, particularly with FANG stocks, one of the strategies I like to do during earnings season is, there's a lot of eyeballs on these, and so if they have a poor earnings report and they come down to support, I like to watch for reversal signals. And if I see one, then I think it makes for a good entry into a potential bounce trade. Now, these aren't long-term trades where I'm looking to get a multi-week swing. These are typically what I want to do is see a quick bounce. And so you can see I highlighted it on my chart. We had this 3-day candle pattern. We had 3 long wicks right around the 50-day moving average. When we had this turn with the green candle closing above the previous day, this was a nice long entry signal. And so on Monday I pointed it out as a good place to go ahead and try to enter. And so far, as you can see, since Monday, Tuesday, Wednesday, we've had a decent run up. Now, it's not a majorly great trade for us. We're only up about, I think I entered around 515, so we're up about 5 or 6 points. But it's a nice little bounce trade. And the other one we did on was Tesla, which was basically a day trade yesterday. And it was the same idea. We'll go to 50-minute chart. You can see what happened. It basically trended down, and once it reached the point where we thought it was overbought, you can see that movement came in, and it gave us a nice little bounce trade during the daytime. And so one thing I like to see is these stocks, these FANG stocks, or Tesla's not a FANG stock, but it's pretty closely related to them, is when they have a sell-off during earnings, a lot of times there are a lot of traders or a lot of eyeballs watching to try to buy the dip on them. And it makes sometimes for easy bounce trades on them. And so both worked out pretty well for us. As you can see, Tesla's still pretty flat. This is why I like to say that these are short-term trades, is because there's still a lot of selling pressure. There was still a negative reaction to earnings, so we're not looking for a complete trend shift. We're just looking for a reactionary bounce off of buyers that are trying to get in at better prices. And then finally, the last one we want to look at is Google. And Google reported as well, and as has been the case for the last half year or so, Google is the one that's outperforming as far as the FANG stocks are concerned, and it had a good earnings and it bounced up, and it's part of the reason why the Qs are still holding up okay. So you can see mixed bag. We still have a few to report, and they will have an impact on how the markets behave, but overall I don't see anything. I don't see an overarching trend that would point to either positive or negative moves on the NASDAQ. So I think that means, like I said with the S&P 500, that we're just generally going to be trading off of the current price action, which is going to be reminiscent of what we've seen over the last week or so. So we should probably either inch up towards new highs or come back and retest the 20, maybe drop down to the 50. But I think more likely than not, we're just going to kind of stick around the current price area until we get a little bit more catalyst for change and we get a little bit more momentum in either direction. So far, from what we've seen out of the S&P and the NASDAQ, I don't think that we have a clear picture as to whether we're going up or down in the next week or so. My suspicion is, like I said, that we probably try to push to new highs, and I think if we fail, that's when we come back and start testing the moving averages. But it could be that we need to come back and kind of sit on the 20 a little bit longer, maybe even breach below it. If that's the case, then like I said, more likely than not what happens is if we lose the 20, we're going to come to the 50, and then we're going to chop between the two moving averages, and then either resolve to the upside or downside. More likely the upside, but we'll kind of cross that bridge when we get to it. For now, major levels, we've got obviously resistance right above us at 368 that we're probably going to test. Below that we've got the 20, and then we've got a decent support level here around 350, which the 50-day will probably come up to meet price around there. And then the major level is 342, which I don't expect us to approach from here to next Wednesday. Now, next up we have the Dow Jones. And so the Dow has been in a little bit of a different spot compared to the S&P and the NASDAQ. And I think this was reflected in the way stocks have moved recently. I think it was a good example of the kind of rotation that we were seeing, which was money was rotating back into tech and away from some of the recovery names that were part of the Dow Jones. And so the Dow started to really lag in June and July. Now it's starting to kind of firm up a little bit. I think money's kind of rotating back in a little bit into these recovery names. However, I'm hesitant to lean into them too much because I think that we're still seeing a lot of negative news as far as the coronavirus is concerned, and I think that might still put some pressure on recovery stocks. So I'm not that excited about trading Dow names. However, that being said, if we're just looking at the Dow in a vacuum, it is kind of forming up like it's ready to break out. Typically when you have a long consolidation like this and you have a long base, you have a test, you come back, you come up, you test, you fall, you come up, and you can see typically what you want to see is you come up and test a breakout and you consolidate just above it, and then you break out. Now it actually failed, right? The first time it tried to do this, and it came down. Then we had that big shift that happened just last week, and now we're trying again. We're just building up right below highs, ready to break out. And this is maybe the best hint so far that the markets probably want to try to push up to new highs before they come back, is we already had a pullback and we came right back up to highs and we're consolidating just below highs. So I think there's a pretty good chance that we're going to try to break through the highs. Now whether that breakout is sustained or not is still up for debate, right? And we're not going to really know until we see it happen. But the Dow Jones looks like it's ready to break out, and it looks like it's really trying to build up momentum to push to new all-time highs. And if it does so, I think there's a very good chance that the S&P 500 and the NASDAQ do the same thing, and they all move up together. If it fails, well, you can see the 20 and the 50. They don't have that same alignment that we saw with the NASDAQ that was indicative of a strong trend, but it has the beginnings of it, where you can see the 20 curling through the 50 and coming up, and you see the 50 kind of spreading below it. So this could be the beginning of a nice rally coming on the Dow Jones. It could not. There's no way of really knowing until we see it happen, but this right now to me looks like a pretty bullish pattern that's ready to emerge, right? And for the moment, this is good risk reward for someone that wants to go ahead and try to play that breakout if it does happen. Whether it's with a Dow name or whether it's with the Dow itself, really it's up to you, but this actually does not look too bad as far as the kind of price action you see before a breakout. Now again, if it fails, we're probably going to come back and retest the 20. And we may even come back and test this channel, which for the Dow Jones, like I said, it's despite the fact that we've had a lot of sideways, and you can see this is a pretty wide base. Generally speaking, we're still kind of conforming to this channel that was first formed back in November of last year, where we kind of broke out to the top of the channel, then we came back inside of it, and we've flirted twice now with breaking below that channel, but we haven't actually really conclusively rolled over. And so we're coming to a spot here where something is going to happen soon on the Dow. It's either going to break out or it's going to decisively break this long-term trend line that's been holding steady, and then come back and maybe refill back into the 330s, and maybe even a little bit below that. So something's going to happen soon with the Dow. This is one to watch. This is one that could give us a good tell as to what the price action is going to be, and what's going to be the next step as far as the overall markets are concerned. And then finally, the last index we want to look at is the Russell 2000. And as you can see, this is completely different from the other three. At the moment, as we're through IWM, which is the ETF that follows the Russell 2000, you can see we're below the 20, we're below the 50, we're nowhere near all-time highs, and we're right smack in the middle of the base that we formed since the beginning of the year. I think this is, again, indicative of the fact that a lot of recovery names are starting to get more sluggish. And a lot of the more volatile assets, or the riskier assets that are small caps, traders are beginning to want to avoid them or not really get stuck in them. And because of that, you can see that we are really just kind of stagnant. Now, I think that the markets can rally without IWM. This is something that, over the last decade or so, there has been a lot of times where the NASDAQ and the S&P 500 rally, and IWM is just kind of stuck in mud. So I don't think that this is enough of a warning to say that we can't rally in the markets. What I would point out is that this, again, is indicative of an attitude or mindset in the marketplace where they are looking at specific names rather than all names. When you have the strongest rallies in markets, all names rally together. So, for instance, in November and December of last year, we had a very strong rally, and you can see everything channeled up at the same time. If you recall what we saw with the S&P 500, with the NASDAQ, with the Dow Jones, all the charts had the same pattern. And in the strongest of market conditions, you'll see that. However, when you don't see that, that doesn't mean that the market won't rally. It just means that you're not getting those absolutely strong conditions where everything moves together and it's almost impossible to make a mistake trading. I think at this point, you still need to be cognizant of what pockets of the market are moving up and where money is feeling safe. And at the moment, I don't think money feels safe in some of these smaller cap names. And so you have to keep an eye on that. And you have to have, I'm not saying you need to avoid trading small caps. What I'm saying is you need to be more aware of the fact that there's a good chance that you need to be quicker about taking profits or stopping out, because the momentum is not quite as sustainable on these names as they are on maybe on the NASDAQ or the S&P 500 names. And so that would be one of the keys that we want to take away from today, is make sure that you have a quicker trigger finger if you're trading some energy names or some biotechs or anything else that maybe isn't quite a big tech name, and is generally speaking trading in one of these kinds of patterns. Now, level-wise, what can we really gauge here? Well, we have immediate resistance overhead with the 20 and the 50-day moving average. And then obviously all-time highs are going to be a big ceiling and a big wall that we need to break through, which I don't think happens anytime in the near future. I think what we want to see right now is that the other three indices break out to new highs, and we see IWM just get back above their moving averages and kind of hover in this pocket here in the 230s. Now, to the downside, we have a very important level right here around 208, which of course is not only the floor of this range, but where the 200-day moving averages come up to meet price. This is not something that wants to be broken, or that can be broken. If we break this, then I think we start to see more negative implications across the board rather than just being relegated to the IWM and to the small caps. So what I mean by that is if IWM just keeps chopping around but stays above the 200, then I don't think it's going to have any impact on the S&P, the NASDAQ, and the Dow. But if IWM starts to break below the 200 and starts to fall into this area below the, into the low 200s or 190s, then I think at that point we're going to see that reflected or start to impact some of the other indices, and they're probably going to pull back and start testing their moving averages or some of their lower levels, because that will be more indicative of stronger price or stronger selling across the board. All right, so that covers it for the four major markets. Like I said, for the most part, we have a market that's pretty bullish. If you just ignore IWM, I would say it's a market that looks ready to rally. However, with IWM in the picture, we get a little bit more of a mixed bag, and we'll see what happens with today's close and tomorrow, as Facebook and Amazon report, and then we'll get a better idea of exactly where the market wants to go next. But overall, I'm still pretty bullish, and I think more than anything, we just want to wait for the right opportunities, and we want to wait for good risk-reward opportunities to trade, rather than just trying to chase price action. Now, let's take a quick look at the US dollar. We'll look at oil, gold, silver, and then we'll move on to charts. If anyone in here has a chart they want me to look at, I'd love to see what you guys are trying to trade. Also, if you have questions about what I'm saying and you want me to elaborate, feel free to to interact and to just put a message on here. I'd be more than happy to explain my process or what I'm seeing or why I think certain things. But let's, again, quick look at the US dollar. We'll also take a look at Bitcoin and Ethereum as well, as that we finally saw some really strong momentum on those. Not sure if anyone in here is into cryptocurrencies, but we finally got some really good returns over the weekend with those. So first up, the US dollar, which of course moves everything. And as you can see, the US dollar is still trying to extend this breakout through this range around the 2480 range. We had a nice breakout, kind of consolidated, broke out last week, and it's pulled back over the last 4 or 5 days, but it's still holding steady. And this is actually a decently bullish chart pattern. If we look at the Euro-US dollar cross, which is going to be the inverse of that, you can see sort of the same picture where you had the US dollar break out, which of course would mean down for the euro, and then there's been a 2 or 3 day pullback as the euro starts to bounce. But overall, this is still looking pretty bearish for the euro, and kind of positive for the US dollar as it continues to hold above or below a key level. And at this point, we'll see exactly, does it need to come back and retest 119, or does it try to extend this move down, and then, as it deals with this 20-day moving average. The other crosses we like to look at is the US dollar yen. And as you can see here, this one's more neutral, which is very interesting because when the US dollar was weak, it actually performed very well versus the yen. And now that the US dollar has started to firm up, the yen has picked up strength as well, and is starting to push back against it. You can see we had this nice channel that broke down below it. We have an interesting pattern developing here. This could end up being a pattern where the US dollar bounces and starts to make its way back up, or we could get a rollover. I would expect resolution in the next couple of days. If you're a currency trader, watch to see what it does here with the 20 and the 50. If it breaks back above the 20-day moving average, then I think it's going to make its way back up into the 111, 112, 111, 111.5. If it fails to do so, then it probably heads back down to the 109, maybe even the 108 area. And then excuse me. The last chart we're going to look at is the U.S. Canadian. I pointed out a few weeks ago, for those that follow me every Wednesday, this was looking like a pretty good trading opportunity, particularly as oil started to pull back. That has actually played out, and the U.S. Canadian has given traders a very nice move, coming from all the way in the low 120s, all the way up to, it topped out here around 128, but even now at 125, this was a very nice move. And again, I thought a pretty obvious move, as the U.S. dollar was starting to pick up steam just as oil was starting to lose momentum. And for those that maybe aren't aware, the U.S. Canadian often trades at an inverse to, at an inverse correlation to oil, because it's one of the big commodities that gets traded between the two countries. And you will often see, if oil rallies, you'll see the U.S. Canadian suffer, and if oil pulls back, you'll see it bounce up. And so I thought this was a very easy trade and a very clear trade, and hopefully someone that watches these videos took advantage of that, because it worked out very well. Going back to oil, you can see oil really struggled here. It was trying to rally at the 75 range, and then we had a really sharp sell-off. It did come up to a pretty decent area of support, and we found buyers, and it bounced, right? And so I think at this point what oil is doing is basically establishing a new range, very similar to this range that we saw back in February, March, and April, where it kind of bounced between 58 and about 68. Well, now we're here at the 67, 68 range with about 75, 76 as the ceiling. And we're probably going to bounce back and forth between the two. It's kind of in the middle, so it's not really a good trade in either direction at the moment. And I imagine oil-related names are going to be in a similar spot where it's very difficult to try to gauge where they are because they probably followed suit and just dropped and then maybe bounced. I think for the moment, this is something I'm staying away from because it's, like I said, there's potential for it to try to challenge highs, but there's also potential for it to fail at the moving average and come back and retest the floor first. And then the last two commodities we're going to look at is gold and silver, which I'm still not that interested in trading. GLD is doing an okay job here. It broke this, so we've got a long-term, I'm going to go to the weekly chart for this, got a long-term downtrend here that we are really trying to break here. And at the moment, it did break it. And we actually have a potential trading opportunity here. One that I probably will ignore, but I would say that it's actually a pretty decent trading opportunity for anyone that wants to look at it. Now, this descending trend line is up for interpretation. If you're a conservative trader, you probably want to wait for this to break through this descending trend line. If you're an aggressive trader, then you've got something right here which could lead to a break above the 20-day moving average, and this 168 could lead to a quick move up to the 170, 171. Now, the reason I'm staying away from GLD is because it's been such a messy trade, and the US dollar is starting to pick up strength, and this potential trade gives us 2 or 3 points. Now, granted, you know, we're getting decent risk reward, but even then, we're looking at risking 1 point to make 2 or 3 points. I feel like if I'm looking for an inverse dollar trade, I still prefer what I'm seeing out of cryptocurrencies. I know not everybody likes those and not everybody wants to trade them, but that's still something that I kind of prefer trading right now if I'm looking at an inverse dollar play compared to the precious metals. Now, that being said, if you're someone that likes precious metals, if you're someone that wants to trade gold and silver because you're comfortable with it or you're familiar with it, well, this is actually not a bad looking setup here for a move at least into the 200-day. Now, will it get back into the 170s and above? I don't know. That's still up for debate, particularly with the US dollar strengthening up, but it could happen. And then the last one is silver. And SLV, as you can see, actually looking worse than GLD at the moment, with a pretty decent breakdown below the 200-day moving average. Now, it is still within this. It's like a really loose and sloppy channel here, right, or range, and it's kind of at the bottom of that. So there are some traders that will look at this and say, well, this is decent value and there's a potential for a bounce trade, and I'm not going to disagree. Like I said, there are other charts that I find more interesting than this, or I would prefer. However, there is potential here for those that are willing to take the shot, where you have a stop here at 22.60, so about 40 cents away, and you do have a good 2 or 3 point upside if it's going to make its way back up to this channel eventually. Now, for that to happen, I think the US dollar would need to struggle more versus the euro, but this is a potential. If you're a precious metal person that likes to see these, this is something you want. This is something maybe you want to pay attention to and see if we get a full reversal pattern here. We're not seeing that yet, but it could be that it develops over the next few days. At the very least, it would need to break above maybe something like this, and at that point maybe you could look at it. Alright, so if I'm ignoring these, it's for a reason, and the reason is because I could take this right now. Of course, at this point, you're not going to trade Bitcoin to the long side, at least not in the short term. It already had its breakout. But if you look at this, we outlined this a couple of weeks ago, this potential breakout that was coming, and you see this kind of move from 32 to 40,000, 8,000 points or $8,000 in the span of a week. I feel like this has really soured my taste for trading gold or silver, is because I feel like I can get so much better returns trading Bitcoin or trading Ethereum. As you can see, even Ethereum, and Ethereum was a little bit of a worse one because it didn't have a clear point here, but even here from 21 to 24, if you just waited for the break of that trend line, these are the kinds of moves that I prefer trading nowadays compared to what I'm seeing now. Of course, there's on the opposite side of that, there's a lot more downside on these. But if you know how to stop out, or if you know what levels you want to go ahead and enter, then you can still manage your risk or reward on these just the same. And they're 24-hour markets, so you don't have to wait. One of the problems I have with gold and silver is a lot of times with those, there's overnight moves because I'm trading an ETF. And if gold has an overnight move, I have to wait for the next day for whatever gap up or down it has to manage my risk. With Bitcoin or Ethereum, I can hop on, whether it's Coinbase or Binance, and make my trades at any time of the day, any time of night. So I never have to really worry about an overnight move affecting me. So it makes it easier to manage my risk on this, even if it is a much more volatile instrument compared to what we see with gold or silver. And so I've been gravitating to this. Those that follow me regularly know that this has been a focus of mine this year, has been trading some of these cryptocurrencies. If anyone in here, by the way, has questions regarding these, regarding how to get involved in this, or if you want to see some of the smaller altcoins that I like to look at and trade, feel free to type it in, and I'll be more than happy to give you a better rundown of what it is that I like to trade with these cryptocurrencies. If not, we can call it a day. So let me know if you guys have something you want me to kind of point out. I don't really have any other charts to look at. Like I said, the two charts that I traded this week, or that I pointed out on Patreon, were Tesla and Netflix, which were basically post-earnings trades. It will likely be the same case next week, where we look at post-earnings trades on either the FANG stocks or some other tech names that reported this week. And then, like I said, as far as cryptocurrencies are concerned, there's been a new resurgence in momentum in these, and while Bitcoin and Ethereum maybe have kind of moved up where it's hard to chase, there are a lot of other smaller coins that are still in the process of bouncing and giving us potential moves. And as you can see, I follow a decent amount, and I have trades in quite a few of these as well. Okay, well, I guess that covers it. I don't see any questions in the chat. For those that are in here, if you want to ask a question, but you don't want to ask on Twitch, you can visit me at you just go to StockDarts at Twitter, and I'll be more than happy to answer your question through there as well. You can email me, stockdarts@gmail.com. I'll be more than happy to send you whatever it is you want me to look at through there as well. I like to help out traders. I do these for free every Wednesday. Part of it is for me to just kind of analyze the markets, but part of it is to kind of interact with new traders and give them an idea of how to use technical analysis. I feel like technical analysis is often misunderstood and misrepresented in the trading community. A lot of people think that it's just hocus pocus, where you're trading, where you're just drawing and connecting dots, but each one of these marks on this chart identifies a type of trading psychology. And so I think that as you learn to read these trend lines and read these moving averages, you learn to identify market sentiment, and you learn to identify what people think. Ray, good to see you in here. You said you're long CL. Long oil or long CL the stock, which is, what is it, Colgate. I imagine you mean long oil. Oil. Okay, now you're long oil as in the oil contract, or long through like USO or something? Wow. Well, Ray, those are pretty volatile contracts. Are you doing okay with those? All right. So when did you enter? If you're looking for 88, when did you enter? Okay, so you've been in and out. Be careful with that. Even with the mini contracts, oil could be pretty aggressive with the moves. Um, as I mentioned before, I feel like oil is right in the middle of the range. I'm not going to say a long is necessarily a bad idea because it's not really. But I mean, it depends on when you got in. You have a position. Oh, wait. So you're long, but you're wrong. You have one position from 74, which means that you've been in for a while. Okay. Oh my. So you actually held through this entire drop. Um. All right, Ray. Time for your weekly criticism. You got to be careful with futures, Ray. You got to really be careful about your stops. You don't want to hold through these kinds of big drops. Now, can oil get back to your entry and get back to 76 from here? Yeah. We'll see what it does at the 20-day moving average. Like I said, it's if you really think about it, what do we got? We got 75. We got 67, right? So that's about 8 points. We are basically about 3 points from the high and about 5 points from the bottom, or 6 points. So we're kind of in the middle of the range. There's, like I said before, there's just as much chance that it comes back up to 75 as there is that it comes down to 67. You mentioned here you missed out an exit at 77, yet you say your target is 88, or that you think it's going to 88. So, I feel like you're saying by hindsight you missed it. But you have to make sure that you stop out because these drops are really big. And I would one thing to say. So you say you're doing okay, but that one you had not placed a stop that day and you left to find. So as I've traded futures before, I've traded a lot of volatile instruments in my day. When I was day trading futures, if I had to leave the house or if I had to walk away, even if I was just walking to the kitchen, I would never leave my computer without putting a stop in place or closing the trade. Ever. Because you never know what's going to happen the minute you walk away. And so, no matter what the reason is, you never leave without, if whatever, I'm going to miss out on the move, then I just close it. And so obviously you put yourself in a position now where you're down on the trade. You were able to avoid a big loss. I would be very careful. If this loses to 50, it could come all the way back down to 67. So it seems like every time we talk, there's a trade that a day trade that you end up marrying and you end up trading for a long time. Kind of like that J Nugget trade you had. So, just be careful, Ray, that you don't let it get to this point where you're holding a futures contract for weeks at a time. Okay. But other than that, good luck with that, Ray. Hopefully the futures are helping you. And hopefully you have worked through some of the issues you've had with trading recently. If you ever have you have my email, you have all my contacts, so you can always ask me questions there. But good luck with that. Hopefully it bounces for you, and hopefully it gets back up into the 70s, or into the mid 70s. Other than that, I think we could wrap it up for today. It was good to see you in here, Ray. The others that are in here that I didn't hear from, thank you for attending. I appreciate you watching. I hope you guys have a good rest of this week, and we'll meet again next Wednesday.